Welcome to the Deep Dive. Our mission today, well, it's to cut through some of the noise around personal finance, wealth building. We're going to dig into key insights from excerpts of Tony Robbins' book, Money, Master the Game.
Yeah, and we've got quite a bit to work with here. We're looking at reflections from the author himself, some really powerful anecdotes, hard data points, and also perspectives from interviews with, absolute titans in finance.
Exactly. And the goal isn't just, a summary. It's about pulling out those nuggets of knowledge, the insights that you can actually put to work. Because let's be honest, money stuff can feel super complex.
Oh, definitely. The material we looked at really hammers that point home. A lot of people feel overwhelmed, like this is too complicated or it's just not my field.
Yeah, and it even kind of suggests the system itself. Maybe it seems designed to be confusing sometimes, perhaps to keep you from really taking the reins.
It does. It sets up this interesting contrast, between the few who do, the ones who get the wealth and the joy, and then the many who just talk about it. And the author kind of positions himself as someone who went out and studied these excellent individuals, figured out what makes them tick, and then tried to simplify it, clarify it, make it a system others can follow.
And the core idea threading through it all seems to be that, look, finding financial freedom.
Yeah.
It's maybe not as confusing as it feels. It's more about understanding some key principles and then, this is crucial, actually doing something about them.
Absolutely. So, okay, let's set the scene a bit. The sources, they paint a pretty, a stark picture of where many people are financially right now. Why aren't more folks secure?
Well, the data jumps out right away. It's pretty sobering. There's one stat from the Center for Retirement Research. It says 53% of American households are at risk, meaning at risk of not having enough money in retirement just to keep living like they are now, over half.
Wow, 53%. And when you drill down into actual savings?
Yeah, it gets worse. More than a third of workers have less than $1,000 saved specifically for retirement. That's not counting, pensions or their house.
Less than $1,000.
And 60% have saved less than $25,000.
Right. That really puts that 53% number into context, doesn't it? And you look historically, U.S. savings rates have been, pretty dismal. The sources mention figures like 1.5%, 2.2% in past decades, maybe deking a bit higher sometimes, but generally low.
And the whole landscape of retirement itself has fundamentally changed. That's a huge piece of this. Think about pensions.
Yeah, exactly. Back in the late 80s, what was it? Over 60% of workers had one?
Something like that, yeah. Over 62%. And today, they're rare birds, unless you're maybe in government work.
Oh, right. So the risk, the responsibility, the cost, it's all shifted. It's on the employee now with 401k mostly.
Yeah.
The material is crystal clear on this. You are absolutely the captain of your financial ship now. No question.
And the old safety net, Social Security, that's facing huge pressure too. The ratio, workers paying in versus people getting benefits, it's plummeted.
Dramatically. What was it? 16 and a half workers for every recipient back in 1950.
Yeah, and by 2010, it was down to 2.9 workers.
Yeah.
The basic math just doesn't hold up long-term without big changes.
So, okay, we've got this challenging external picture. What about inside our own heads? What are the things holding us back? The behavioral stuff.
Well, that feeling of being overwhelmed, the complexity we mentioned, that's definitely a big one. But the sources, they go a bit deeper. They touch on the science, suggesting maybe we're not always the rational decision makers we think we are.
Ah, yeah, the cognitive illusions idea.
Exactly. It uses that organ donation example. Just changing whether you have to opt in versus opt out makes a massive difference in how many people participate.
Right. It shows how easily we can be nudged, maybe without even realizing it.
Totally. And tied into that is the story we tell ourselves, right? We blame outside stuff, or we feel like, oh, I'm just not good with money. But the text argues, look, often the real roadblock is just our own beliefs, our perceptions about what's even possible for us financially, these limiting ideas.
And that line really stood out to me. We get what we tolerate. If you tolerate making excuses or believing you can't do it or staying stuck in fear, well, that's kind of setting your own limits, isn't it?
It really is, which brings up the idea of a breakthrough.
Right. That moment where suddenly something that seemed impossible just clicks and it feels possible.
Yeah. And it often comes from, hitting rock bottom, that enough is enough feeling, or maybe seeing someone else succeed and that inspires you. It's like drawing a line in the sand, deciding, nope, this is my new standard.
And speaking of internal states, that danger of tying your identity, your self-worth to your bank balance, that's powerful stuff.
So that anecdote about Adolf Merkel.
Yeah.
The billionaire.
Yeah, losing a lot, feeling like a failure despite still having billions, and tragically taking his own life. It's a stark reminder of how easily we can fall into that trap, thinking our net worth equals our human worth. It's really dangerous.
Definitely. Okay, so we understand the landscape, the mindset challenges. How do we actually start building that security? The material's really clear on this. The most important decision isn't about how much you earn.
Right. It pushes back hard on that idea that you can just, work more hours, climb the ladder, and earn your way there. The paycheck's important, obviously, but it's not the whole story.
It introduces that cool metaphor, building a machine.
Yeah, like something that works for you, generating wealth 24/7, even when you're sleeping, once you get it going.
And the absolute first step, the critical move to start building it, it's deciding how much of your paycheck you actually keep for yourself.
Pay yourself first. That's identified as, the cornerstone. Everything else builds on that.
Makes total sense. Because that's where the real magic, the compounding, that's where it kicks off, right?
Yeah.
And this decision, it's step one in the book's 7 Simple Steps to Financial Freedom.
And there's a strong point made about knowledge versus action. Just knowing you should save isn't power. It's potential power.
Right.
Execution, actually doing it, that's where mastery lies. If you know you ought to save systematically, but you're not, the sources basically say, well, you don't really know it in a way that counts.
Okay, so practically then, how do you start paying yourself first? The advice seems pretty concrete.
Yeah, it's like start with 5%, or better yet, at least 10% of your income. And set it up so it automatically goes into a separate account, like a freedom fund. Maybe your 401k is the easiest place.
And then the key is committing to bump that up, right? Like add another 3% every time you get a raise.
Exactly. Automate the increase too. And they stress how easy this can be. A few clicks online, maybe use a template email they provide to send to HR. It's designed to be simple.
It reminds me of that Richard Thaler concept, save more tomorrow.
Yeah, they reference that, showing how people who felt they couldn't save anything were able to boost their savings rates quite a bit over time just by committing future raises.
You make the decision once, let the system handle it.
Okay, decision made. We're paying ourselves first. But the next hurdle for a lot of folks is probably, okay, where does this savings money actually come from? Right. And the material really pushes you to challenge your assumptions about where your money's currently going. It introduces that term, latte factors.
Yeah, it's catchy. And it's not just about coffee, is it?
No, not at all. It's a symbol for all those small, kind of mindless daily spends that just leak money. But the coffee example they use is powerful.
What was it, like $4 a day on coffee?
Yeah, $4 a day. If you save that instead, and it earned just a modest 6% interest over 20 years, that's almost $56,500.
Wow.
And if it's more like $10 a day, you're looking at over $141,000 potentially lost over those same 20 years. It really shows how tiny leaks sink big ships, financially speaking.
It definitely does. And it goes beyond the small stuff, too. It suggests rethinking bigger ticket items, like cars.
If your financial plan isn't getting you where you want to go, maybe that fancy car, even if you love cars, needs a second look. Could be a big chunk of cash freed up right there.
And home ownership, too. It talks about the banker's secret in mortgages.
Yeah, that blew my mind. On a typical 30-year loan, say at 6%, something like 80% of your payments in the early years is just interest. Pure profit for the bank.
Just interest. Think about the total interest paid over 30 years. It's staggering. A huge wealth transfer.
It really is. And the book even throws out something pretty radical, changing your location.
Right. People move for retirement all the time. Find somewhere cheaper, warmer. The challenge is, why wait until you're 65?
Exactly. Could moving to a lower cost of living area today literally chop years off the time it takes to reach financial freedom? It's a big question, but maybe worth asking.
Definitely a thought provoker. Okay, so you find the money, you start saving. Next up, investing. And this is where I think for many, the complexity feels like it ramps up big time. The sources tackle some common myths here.
Yeah, a big one is this idea that the return number a mutual fund reports is actually what you, the investor, pocket. Jack Bogle is quoted on this.
A Vanguard founder, right.
Yeah, that's him. The sources explain how, perfectly legally, funds can kind of massage their reported past performance numbers to look better than the reality for the average person invested in them.
They give that Dow Jones example, which is pretty stark. The reported average return since 1930 might look like, what, 6.3%?
Something like that, 6.31%. But the actual compounded growth, the real return you would have gotten, was closer to 4.31%.
And the difference that makes over, say, 80 years on just $1,000 bucks, It's huge, like $142,000 versus only $30,000.
Exactly. It shows how average returns can seriously mislead you about long-term growth.
And another point that really makes you think is the chef doesn't eat his own cooking idea.
Ah, yeah, the Morningstar study found that almost half, 49% of active mutual fund managers owned 0 shares in the very funds they were managing.
Wow, 0.
0. And most of the rest only owned tiny amounts like pocket change compared to what they were getting paid. It really makes you wonder, are their interests truly aligned with yours?
Definitely raises questions. The material also gets into target date funds, TDFs. They've become huge, haven't they?
Massive. Apparently, a 2006 law really boosted them by making them a default option in retirement plans. So now, something like 40% of 401k participants use them. Trillions of dollars.
And they're the default for almost all big employers now when they auto-enroll people.
Yeah, over 96% of large employers use TDFs as the default. The pitch is simplicity. It's all handled for you. The asset allocation shifts automatically as you get older.
But not without critics.
Yeah.
The sources mentioned Dr. David Babel calling a key study supporting TDFs heavily flawed.
Yeah.
So convenience, yes, but maybe not perfect.
Right. It's a trade-off, like anything. Okay, moving into some more advanced territory. Taxes. This gets a lot of focus. Understanding taxes is presented as absolutely critical.
Yeah, it breaks down the main types. You've got your ordinary income tax. It could be 50% or even more for high earners.
Ouch.
And then long-term capital gains, which is lower, usually 20% if you hold something for over a year.
And the killer combination is fees plus taxes. The example given is pretty eye-opening. Say your fund has an 8% gross return.
Okay, sounds decent.
But take out, say, a conservative 2% for fees. Now you're at 6%. Then, if you're in a high tax bracket and a good chunk of that gain gets taxed as ordinary income, maybe effectively 50% tax, your net return could be down around just 3%.
Wow, 8% down to 3%.
Yeah, and at 3% net, it takes 24 years just to double your money. Compounding works, but man, it works slowly at that rate.
That calculation alone is huge, and it raises that whole uncertainty about your 401k, right? How much of that balance is really yours after future taxes, especially when you think about past tax rates being much higher and current debt levels.
Exactly. It's a big unknown. So what are the solutions? Well, rolling over old 401ks into IRAs is mentioned because that opens the door to potentially converting to a Roth IRA.
Where the growth and withdrawals could be tax-free down the road.
Right. The point is, being smart about tax efficiency isn't just a small tweak. The sources suggest it could potentially speed up reaching your goals by like 30, maybe even 50%.
That's significant. It also touches on things like cash balance plans. What are those exactly?
They're described as kind of like pensions, but for high-income small business owners usually. They let you make really large tax-deductible contributions on top of your regular 401k.
How large are we talking?
Well, the example given was a 50-year-old potentially putting away almost $190,000 in 1 year between the two plans, tax deductible.
Whoa, okay.
Yeah, they're apparently getting more popular even with some bigger companies starting to use them.
Interesting. Okay, so from taxes, the material pivots to something fundamental. Guaranteed lifetime income. Isn't that like the whole point of saving for retirement for most people?
Pretty much, yeah. Which leads to the discussion about annuities. Are they good, bad? The answer seems to be, well, it really depends. Depends heavily on the type, the fees, the structure.
It looks closer at one specific type, fixed indexed annuities, or FIAs. They've been around since the mid-90s, apparently quite popular.
Yeah, the key features highlighted are 1, 100% principal protection, guaranteed by the insurance company, big emphasis on choosing a highly rated company there.
Makes sense.
2, you get potential upside linked to a market index, but crucially, without the downside risk if the market tanks. And 3, the gains grow tax-deferred, or even tax-free if it's held inside a Roth.
Okay, principal protection, some upside, no downside, tax benefits. Sounds appealing. What about these longevity policies?
Right. Those are a different type of annuity, a deferred one, designed to kick in much later in life, say age 85. The example used is powerful. A 65-year-old puts a $100K into an immediate annuity, maybe gets $7,600 a year for life.
Okay.
But that same $100 into a longevity policy starting at 85, it could potentially pay out over $63,000 a year from that age onwards.
$63,000. Wow, so the value there is...
The value is huge. It means your other savings only need to last until you're 85, not potentially 95 or 100. It dramatically reduces the risk of outliving your money, and it helps combat that nasty sequence of returns, bad market returns right when you retire, hitting your portfolio hard.
Gotcha. That makes sense. But what about the common knock against annuities? If I die early, the insurance company just keeps my money.
Yeah, that comes up. And Dr. Babel has a pretty blunt quote in the text about it. He basically says, if you're dead, who cares? What's really painful is living too long with no income.
Huh. Fair point, maybe.
Yeah. But the sources also mention you can often address that concern. You can add riders for a death benefit refund to your heirs, or just pair the annuity with some cheap term life insurance. There are ways around it.
Okay. So moving back to portfolio building, asset allocation, the sources introduce Ray Dalio's all-seasons approach.
Right. Dalio's whole goal is to build a portfolio that does reasonably well no matter what the economy is doing. Growth, inflation, deflation, recession. He calls them seasons. It's designed to weather those surprises that tend to blindside most investors, even the pros. Think 2008, the dot-com bust, etc.
And the philosophy isn't just about splitting dollars, it's about splitting risk, right?
Exactly. He aims to have 25% of the portfolio's risk exposed to each of those 4 potential economic environments. It's a different way of thinking about diversification.
So what does that look like in practice, the example portfolio was?
It was 40% long-term U.S. bonds, 30% stocks like a broad U.S. index, 15% intermediate-term bonds, 7.5% gold, and 7.5% commodities.
Okay, heavy on bonds.
Yeah, the text explains the logic. Like, the long-term bonds are meant to counteract stock market volatility. Gold and commodities are there as a hedge against unexpected jumps in inflation. Each piece has a role depending on the economic season.
And how did it perform historically, according to the sources?
Pretty impressively. From 1984 to 2013, the actual average annual return cited was around 9.72%. It made money in something like 86% of those years. The down years were few, and the average loss was small. And it supposedly navigated the really rough 1970s with high inflation and interest rates quite well, while the S&P took massive hits.
Interesting approach. The sources also include insights from interviews with financial heavyweights, like a billionaire's playbook.
Yeah, some big names. Carl Icahn gets mentioned, the activist investor, not afraid to shake things up, like challenging Coca-Cola's board on compensation.
Right. And David Swenson, the Yale endowment manager.
Yeah, his big theme is diversification. His view is basically, nobody knows nothing about predicting markets, so diversification is your best protection. He strongly advocates for index funds, broad diversification, low fees, tax efficient.
He used that U.S. versus Japan example from the 90s, didn't he?
Yeah.
To show why you need global diversification.
Exactly. And that simple but vital bond reminder, interest rates up, prices down.
Then there's Jack Bogle again, Mr. Vanguard.
Yep. Echoing Swenson. Nobody knows nothing about market timing or stock picking. He built the biggest fund company in the world on that idea. He argues, investing success is mostly luck, uses coin-flipping analogies, says there's no such thing as a manager who stays brilliant forever.
Strong views. What about Paul Tudor Jones?
He reflects on how life paths often happen by chance. He's known for taking big, calculated risks, aiming to knock it out of the park. But critically, he focuses intensely on cutting his downside first. Also noted for his philanthropy.
And Kyle Bass.
He's highlighted for his ability to see the big picture, the forest for the trees, particularly with the mortgage crisis, when many experts were lost in the details. Understanding risk versus reward is key there.
Finally, Charles Schwab.
His story is about learning early on that the traditional finance industry often prioritized its own profits over the client's best interest. He saw a gap, an opportunity to build a huge business by flipping that, by actually looking out for the customer first.
Fascinating insights from all of them. The material then kind of circles back to what you do with the money you make. It mentions that 3-bucket system again.
Right. Security, risk growth, and dream. The idea is you take some profits from your risk growth investments.
And use them to beef up your security bucket faster.
Exactly. Keep growing the security fund, but also keep taking calculated risks with some winnings in the growth bucket. And this is important, allocate some specifically to a dream bucket to enjoy now. It keeps you motivated, makes the whole thing feel worthwhile along the way.
Yeah, that makes sense. Then the perspective zooms way out, looking at the huge changes happening in the world.
Yeah, it emphasizes we're living in pretty extraordinary times. Lifespan doubling in a century, income tripling, needing way less time just to feed ourselves.
But also massive disruption coming from technology.
Yeah.
That Oxford research predicting nearly half of U.S. jobs are at risk from automation in the next couple of decades. That's sobering.
It really is. Thinking about self-driving trucks replacing drivers, or 3D printing just completely changing manufacturing, printing parts, tools, maybe even houses or clothes on demand.
And this change isn't steady, it's speeding up.
Right.
Exponential growth.
That's Ray Kurzweil's point.
Wait.
Technology feeds on itself, accelerating change. Like Moore's law, but applied to all sorts of information tech. Our brains think linearly, so it's hard to really grasp the speed.
The sources also touch on incredible leaps in health and aging. Kurzweil apparently thinks these are solvable problems.
Yeah, because life itself is seen as information technology. Our DNA is code, ACTG, that can potentially be edited, rewritten. It mentions Craig Venter creating artificial life.
Wow. And regenerative medicine, like regrowing tissue.
Exactly. Using stuff like ECM from pig bladders to help regrow fingertips is given as an example. The idea is our bodies know how to regenerate. We just need to figure out how to switch those processes back on, maybe stimulate our stem cells. Why can a salamander regrow a tile, but we can't? Can we learn how?
Okay, so you have this collision of potentially radical technological change and potentially much, much longer lifespans.
And that brings it right back to finance, doesn't it? Living way longer completely changes the game for financial planning. A plan for 20 years of retirement is useless if you live healthfully for 40 or 50 years past retirement age.
Absolutely critical point.
Yeah.
And finally, after all the numbers, strategies, tech, it comes back to meaning.
Yeah. The idea that true, lasting happiness doesn't just come from getting stuff, from accumulating wealth. It comes from what you give, what you contribute.
It mentions the science of spending, that money can buy happiness, but it depends how you spend it.
Right. Even small amounts like $5 a day can make a real difference to your well-being, especially